In this presentation, we will be calculating the internal rate of return with the use of Excel. Our data is going to be up top. We're going to enter that data into the blue area down below. We do recommend that when working any type of problem within Excel, you put the data up top in the format of text and then the numbers in separate cells so that we can then refer back to it, that being the most efficient way to get the most out of the problems that you are working with. So here's going to be our data. We got the years 0 through 5, and this is going to be our cash flow. We're going to have an initial investment, some type of initial investment that we're thinking is going to pay off. So we're purchasing something, initial investment that's going to give us this much cash flow throughout the 5-year time period. It's not an even cash flow, and our consideration then is which project should we do? How should we compare these projects? Our two formats of calculating would be to calculate the net present value, and to do that, we typically use some type of discount rate, or we can figure out what the internal rate of return is, which in essence is the discount rate or the rate that would require that or make the net present value equal 0. So that's what we'll do that here. The math on that can be a little bit tricky to do, but Excel can basically use a trial and error type method to figure out what that amount should be. So let's take a look at how this will look. We're going to say, all right, here's going to be the years. I'm just going to re-type in the cash flows. So we've got years 0, 1, 2, 3, 4, and 5. And then we're going to say the cash flows are going to be equal to, for A, these cash flows. I'm just going to autofill that down. We're going to autofill down. It's going to take down the relative cell references like so. And then now we can use a function or a formula within Excel to calculate the internal rate of return, which will be the rate of return at which this cash flow will be equivalent to 0. So to do that, it's going to be an easy function within Excel. We're just going to say equals the IRR, internal rate of return, select that item, and then select our series of cash flows, and that'll give us the 2567. 2567. That means that if we use the discount rate 2567 to calculate the present value, then we'll end up at a break even, in essence 0 being our ending number. So let's do that. Let's kind of prove this. Now remember, what we typically do when we think about these items, when we think about different types of projects, is we might think of the net present value with regards to some kind of discount rate in order to present value the dollars. That's one way to think of it. We could also compare the internal rate of return and look for the internal rate of return calculation when we're comparing different types of projects. So let's go ahead and calculate the present value as if we had this 2567, and if we do so, we should get basically a cash flow that will be 0 because we in essence discounted this cash flow to the point where it'll be 0, and that is at 2567. So let's do that here. We're going to say, all right, at 0, it's just going to be, it is what it is. And then we're going to pick up year 1. We're going to use our present value formulas, negative PV, present value. We'll pick up the rate, which is going to be this 2567, comma, number of periods 1, comma, 0, comma, and we'll pick up the future value after year 1, negative present value, select the present value. The rate is going to be this item, comma, the number of periods 2, comma, the payment 0, comma, future value 59.5, negative present value, double click the present value, the rate, comma, the number of periods 3, comma, the payment 0, comma, future value 83,795, negative present value, double click, rate 2567, comma, number of periods 4, comma, payment 0, comma, future value 93,900, and then negative present value, selecting the present value, rate 2567, comma, number of periods 5, payment 0, comma, and future value. Then if we sum that up, equals the sum of our flows, we get 0. And that means that this project is getting an internal rate of return of 2567. So in other words, if we were to say if we wanted to think about the net present value at what we think the discount rate should be, time value of money, then we could pick some other type of rate. If I was to pick, say, 10%, then you'll see that we have a present value that is positive because, of course, the discount rate of 10% is going to be lower than the discount rate at which is going to be necessary to get our present value down to 0. Therefore, if we present value at the 10%, we're coming to a present value cash flow of 84,344. In other words, if we were thinking about today's dollars, today's money, we would think the cash flow is 84,344. When we think about the internal rate of return, we're looking for that rate at which we would discount the cash flows for it to be, in essence, 0. So that's one way that we can kind of judge different types of projects. So the internal rate of return here is 2567. If I double click on it, again, here's the formula. Let's do that for Series B. So we're going to say, all right, years are going to be equal to 0. I'll copy the years this time. Years 1 through 5. And then the cash flows are going to be equal to the cash flow here. I'm going to autofill that down. So we'll autofill that down to years 5 through 5. And then we can do our internal rate of return calculation again. Now, let's just pick a random discount rate now first, and then we'll calculate our internal rate of return. So for example, let's pretend we're going to use that 10% discount rate. So that's going to be our discount rate, and then we want to present value these cash flows based on that discount rate. So that's one method that we can look at, and then we'll change this calculation to an internal rate of return. So let's do our present value calculations with a 10% discount rate. So here's going to be the 119 negative present value, double click the present value, rate 10%, comma, number of periods is going to be 1, comma, payment is going to be 0, comma, and future value is the 35.5. Negative present value, double click, rate 10%, comma, number of periods 2, comma, payment 0, comma, future value, this 53,500, negative present value, double click, rate 10, comma, number of periods 3, comma, payment 0, comma, future value 69.5, negative present value, double click, rate 10%, comma, number of periods 4, comma, payment 0, comma, and future value. One more time, negative present value, double click, rate 10, comma, periods 5, comma, 0 payment, comma, and 69.5. Now, if we sum these up, we're going to say that we have 100,327 cash flow present valued at the rate, discounted rate of 10%. So given time value of money, 10%, we've got the 100,327. So when we consider these problems, we might say, hey, I need to have an internal rate of return. I want a rate of return of 10%. And so if we consider it that way, anything above that 10%, then we would accept. Or we might say that we think the time value of money is 10%, and therefore the present value of these cash flows discounted at 10% is going to be this number. Or we can think about what percentage internal rate of return will this be in order for our present value to be 0. So in other words, what is going to be the percent at which the net present value calculation will be 0, which is of course what we'll do here. I'm going to delete this. We'll do this with our formula. This equals the IRR, internal rate of return. Double click, select this cash flow, and then this rate will make this 0. So we're going to say enter. So at 35.54, our present value is 0. So in other words, our internal rate of return, 35.54. So of these two projects, the 35.54 rate of return is higher than the 25.67. So you would think that would be the most beneficial project.